Welcome to the deep dive. Ever wonder who really pulls the strings in the financial world?
It's a fascinating question, isn't it?
We're talking about an ecosystem where, trillions of dollars surge daily, managed by firms you probably recognize, but whose influence maybe you don't fully grasp.
Right. These aren't just big companies, they're titans. They genuinely shape your money, global markets, even whole economies.
And that's exactly what we're here to unravel today.
Yeah, this deep dive is really your shortcut to understanding these financial behemoths, who they are, what they actually do, and the massive impact they have.
We've gone through a stack of sources, pulled out the key nuggets, the surprising facts.
Exactly, without getting bogged down in all the jargon.
Our mission today, pull back the curtain, show you what's most important in this material. So let's get you informed.
Okay, so to start, let's maybe define the key players. We hear these terms thrown around: asset managers, investment banks, wealth management companies.
Right, they sound similar, but they're not quite the same thing.
Not exactly. They all play in the same financial sandbox, sure, but they offer a pretty diverse spectrum of services. Think portfolio management, that's managing your investments, financial planning, trading, sophisticated advisory stuff for big institutions.
And the scale, you mentioned scale earlier. It's genuinely staggering, isn't it?
Oh, absolutely. The sheer size is mind-boggling. This industry, it's seen exponential growth over decades. We're not talking millions or billions here.
So what are the numbers looking like?
Well, get this. By the end of 2023, the total assets under management, AUM, basically all the money they manage for just the world's top 500 asset managers, hit $128 trillion.
Wow, 128 trillion. That's almost impossible to wrap your head around.
It really is. I mean, more than the GDP of the US and China combined.
hmm
And what's striking is that's a 12.5% annual growth rate, even with recent economic bumps.
And a lot of that is concentrated, right?
Very much so. North America dominates, accounting for over 60% of that total AUM.
Okay, so within this colossal landscape, what are the main types of giants we're dealing with?
Broadly, you can kind of split them into asset management firms and investment banks.
Okay.
Asset managers, that's probably what most people think of. Mutual funds, ETFs, pension funds. They pool money from folks like you and me and big institutions, aiming for diversification, long-term growth.
Got it. And investment banks?
They tend to serve corporations, governments, really high net worth individuals. They do things like capital raising, helping companies issue stock or bonds, mergers and acquisitions, M&A you hear about.
Helping companies buy each other.
Exactly. And managing financial risks. Now, you also have hedge funds, which are kind of alternative vehicles, often higher risk. But for today, we're really focusing on those massive asset managers and investment banks because of their sheer size and market clout.
So this isn't just abstract finance talk. Why should our listeners, why should you really care about these firms? What's the direct link?
This is the crucial part. These firms, they wield significant influence over markets, economies, even how companies are run, their decisions, the sheer volume of money they move. It ripples through everything.
Like mortgage rates, retirement funds.
Absolutely. Mortgage rates, your 401k performance, even the big strategic choices major companies make. They're not just passive investors. They're actively shaping the future landscape.
Okay, let's meet them then. Let's pull back that curtain. We're going to dive into the top 10 by assets under management, starting with number 1, the undisputed heavyweight, BlackRock.
BlackRock. Yeah, they're a financial colossus, truly, world's largest asset manager. Their AUM hit $11.6 trillion by the end of 2024.
11.6 trillion, just one firm.
It's just one firm. Founded in '88, HQ in New York. They're famous for their iShares ETFs. Those are exchange-traded funds like baskets of stocks.
And they're known for being low cost.
Among the lowest cost, yes. But what often flies under the radar is their Aladdin software.
Aladdin, tell me about that.
It's not just some internal tool. It's practically the operating system for portfolio and risk management used by major financial institutions globally. It's huge.
Wow, so their reach isn't just managing money, it's providing the tools for others to manage money too.
Precisely. They operate in 100 countries, 70 offices, pioneers in ETFs, like we said. And their influence is so fast, some people call them a shadow bank.
A shadow bank, meaning?
They wield the kind of power you normally associate with traditional banks, but often outside the same regulatory framework. It's complex.
And that size, that power, it causes ripples, doesn't it? Debates.
Immense ripples. Their size and voting power, because they own shares in so many companies, sparks intense debate. Critics, like U.S. Senator Elizabeth Warren, have argued they should be designated too big to fail.
Too big to fail. Explain that concept quickly.
It means a company is so large and interconnected that its collapse could trigger a catastrophic domino effect across the entire financial system. So the government might feel compelled to bail them out to prevent wider economic meltdown.
A huge responsibility and a huge risk.
Definitely. And BlackRock stays in the headlines. They filed for spot Bitcoin and Ethereum ETFs. The Bitcoin one got approved in January 2024. Big move into crypto.
Interesting pivot.
But then you also see them pausing efforts for a Ukraine reconstruction initiative in July 2025 because of geopolitical uncertainty.
Yeah.
Shows how tied they are to global events.
And there's the ESG aspect too, right? Environmental, social governance investing?
Yes, and that's been controversial for them. They faced criticism, particularly from some U.S. policymakers, accusing them of pushing a, quote, woke agenda. We're just reporting what the sources say here, but it highlights the political tightrope they walk.
Okay, so that's BlackRock, massive scale, influential tech, deep in global events and politics. Let's shift to number 2, a very different beast, the Vanguard Group.
Very different, yes. Vanguard, second largest, $8.6 trillion AUM in 2023, based near Philly, founded in '75, largest mutual fund provider. But their real differentiator is the client-owned model.
Client-owned, how does that work?
Unlike most firms, Vanguard is owned by its funds, which in turn are owned by the investors. You, me.
So the profits go back to the investors?
Essentially, yes. Profits are reinvested to lower fund fees. It directly benefits the people investing. It's a unique setup. And huge in passive investing alongside BlackRock. They manage about a third of the world's passive fund assets.
So practically speaking, if I invest, say, $10,000 a year with Vanguard versus a traditional firm, what's the real-world difference that model makes over time?
It can be really substantial. Vanguard's laser focus on ultra-low-cost index funds means, over decades, even tiny fractions of a percent saved on fees add up. We're talking potentially thousands, maybe tens of thousands more dollars in your pocket.
Ah.
And their whole philosophy has pressured the entire industry to cut fees. It's been a massive win for investors generally.
Okay, number 3, Fidelity Investments. They were actually pioneers before some of these others, right?
Absolutely. Fidelity manages $5.9 trillion directly, advises on $15.1 trillion as of 2024. Boston-based, founded way back in 1946. True pioneers.
Oh, so?
They were the first to offer a no-fee index fund. And commission-free trading, that was revolutionary. Set a whole new benchmark.
And they offer a huge range of things now, right? Brokerage, mutual funds.
Everything. Brokerage, mutual funds, robo-advisors, those automated platforms popular with younger investors, retirement accounts, wealth management. Their no-fee move really forced competitors' hands.
Okay, number 4, State Street Global Advisors.
State Street, $4.4 trillion AUM in 2023. Also Boston-based, founded '78. They're probably best known for their SPDR ETFs. Spiders.
The Piters.
Their SPDR S&P 500 ETF is one of the biggest ETFs globally. Tracks the S&P 500 index.
And who are their main clients? Is it retail investors like me?
Primarily institutional. Think big nonprofits, local governments, universities, foundations. They're also part of that big 3 in index funds with BlackRock and Vanguard. Massive footprint in passive.
Got it. Moving on to number 5, Morgan Stanley. They made a big move recently with E-Trade, didn't they?
They did. Morgan Stanley. $4.01 trillion AUM in 2024. Big market cap, too. $171 billion in 2025. New York, founded in 1935. Strong wealth management division, and acquiring E-Trade in 2020 was huge.
So that wasn't just about adding clients. It fundamentally shifted their market position, made them more accessible.
Precisely. It let them serve a much broader range of investors, adding that discount brokerage piece for everyday folks. Beyond that, they're really strong in tech and healthcare deals, equity underwriting, helping companies issue stock and IPOs, initial public offerings.
Okay. Number 6, a household name. JP Morgan Chase & Co.
Huge. JP Morgan Chase. $3.2 trillion AUM in 2023, but a market cap over $660 billion in 2025. New York again, roots back to 1799. Largest bank in the U.S. and a leading global investment bank.
What's their big focus lately?
Heavy investment in fintech and digital banking. They're constantly innovating their tech platforms. That, plus their strong risk management and global network, keeps them dominant in capital markets.
All right, number 7 takes us overseas. UBS Group.
UBS, based in Zurich, Switzerland. Founded way back in 1862, they reported $3.96 trillion AUM in 2022. And they have a distinctive claim.
Which is?
They call themselves the only truly global wealth manager.
Bold claim.
It is. And their strategy reflects that. Big focus on expanding wealth management, especially in Asia and the Middle East, where AUM growth is faster than in developed markets.
Yeah.
They're chasing that rising wealth.
Makes sense. Number 8, Back to the U.S. Charles Schwab Corporation.
Schwab, $3.3 trillion AUM in 2022. San Francisco-based, founded 71, a leading discount brokerage. Known for low-cost trading platforms and tons of educational resources for investors.
They've been growing fast, haven't they?
Incredibly fast. Jumped 34 places in global rankings in just 5 years. Their low-cost model really shook up the traditional brokerage world, made investing much more accessible for ordinary people.
Okay, number 9, T. Rowe Price.
T. Rowe Price, $1.61 trillion AUM as of 2024. Based in Baltimore, Maryland, founded 1937. They're a major player in workplace retirement plans, think 401ks. Also offer IRAs, 529 education savings plans.
Anything distinctive about their approach?
Well, one thing is their funds often have slightly higher fees compared to, say, Vanguard or BlackRock's index funds.
Why is that?
Often because they focus more on active management. That means they have fund managers actively trying to pick winning stocks, rather than just passively tracking an index like the S&P 500 that costs more.
Right, active versus passive. Got it. And finally, rounding out the top 10, Blackstone.
Blackstone impressively just crossed the $1 trillion AUM mark in March 2025. New York, founded 1985. They're the world's largest alternative asset manager.
Alternative assets, what does that mean exactly?
Basically, investments outside traditional stocks, bonds, cash. Blackstone specializes in private equity, investing directly in private companies' real estate and credit investments.
So not stuff the average person can easily buy on the stock market.
Generally not, though that's changing a bit. They manage a massive portfolio over 12,500 real estate assets, 250-plus companies they own stakes in, that $1 trillion milestone. Driven by the growing hunger for these alternatives, even among wealthier individuals looking for diversification and potentially higher returns.
Wow. So that's the top 10. Immense scale, different strategies. But they're not standing still, are they? How is the whole industry landscape changing? What are the big trends?
Definitely not standing still. The landscape is very dynamic. Several key trends are shaping things. One huge one is the continued rise of passive investing.
We touched on that with Vanguard and State Street.
Exactly. Those index funds, ETFs, they now account for nearly 34% of AUM among the top 500 managers. BlackRock, Vanguard, State Street dominate. And this trend keeps putting pressure on active managers to lower fees and, frankly, prove they're worth the extra cost.
Makes sense. What else?
The growth of alternative investments, like we just discussed with Blackstone. Investors are increasingly looking at private equity, real estate, hedge funds, seeking diversification, maybe higher returns, especially when interest rates are higher.
So firms like Blackstone, Apollo, KKR are benefiting.
Seeing significant growth, yes. Private markets look attractive in this environment.
And technology must be a huge factor.
Massive. Investment companies are pouring money into fintech digital platforms. Think BlackRock's Aladdin again, JP Morgan's digital banking, Fidelity's robo-advisors.
Right, those automated investment tools.
Yeah. These tools boost efficiency, cut costs, and crucially make investing easier and more accessible for regular retail investors.
We also mentioned ESG earlier, environmental, social governance investing. Is that still a major trend?
It is. There's definitely growing demand for sustainable investing options, and firms are responding by offering more ESG-focused funds. Now, as we noted, it's complex.
With the criticism aimed at firms like BlackRock.
Exactly. Some policymakers accusing them of pushing an agenda. It's politically charged. But overall, sustainable investing remains a priority for many firms, driven by investor interest.
What about regulations? Are governments keeping a closer eye on these giants?
Constantly evolving. Global regulations are shifting, trying to better align firms with client interests, enhance stability. You see proposals in the U.S. like designating firms too big to fail, reflecting those concerns about systemic influence.
And elsewhere.
In emerging markets, as they grow, you're seeing regulatory frameworks tighten up to better protect investors. It's a global phenomenon.
And speaking of emerging markets, that's another key trend, right? Expansion.
Big time. AUM in places like South America, Asia, Africa, the Middle East, it's growing faster than in developed markets. Yeah. Driven by rising wealth, a growing middle class.
Which is why firms like UBS and BlackRock are investing heavily there.
Precisely. They're following the money, expanding their presence to capture that growth.
Okay, so lots of adaptation, lots of growth, but it can't all be smooth sailing. What are the big challenges facing these giants?
No, definitely not immune to challenges. One obvious one is just market volatility.
Economic uncertainty, inflation, geopolitics.
All of it. That can hit their AUM hard, shake investor confidence, lead to money flowing out.
And the pressure on fees isn't going away, is it?
Not at all. That proliferation of low-cost, even no-fee products keeps squeezing margins. Especially tough for firms relying more on higher-cost active management, like we mentioned with T. Rowe Price. It's a race to the bottom on fees, great for us investors, but challenging for the companies.
What about the regulators? Still watching closely.
Increasingly so. That scrutiny over their influence, market stability, corporate governance, it means more compliance, stricter rules, more costs. It's a major hurdle.
And competition. It's not just the big guys battling each other.
Right. The industry is fiercely competitive. You've got new entrants shaking things up, those robo-advisors like Wealthfront or Empower, offering automated low-cost solutions. They're challenging the traditional models, forcing everyone to innovate or risk getting left behind.
So let's try and bring this all together. We've covered a lot of ground.
We have.
The world's largest investment companies, these giants like BlackRock, Vanguard, Fidelity, they manage literally trillions. They fundamentally shape global finance.
Their scale, their innovation, their adaptability.
Hmm.
It's defining our current economic era, really.
And for you, our listener, understanding these players is, well, it's pretty key, wouldn't you say?
Absolutely. Choosing the right company, whether it's a broker, an asset manager, it really boils down to your own goals, your comfort level with risk, what services you actually need.
Are you looking for rock-bottom trading costs, comprehensive retirement planning, sophisticated wealth management? Different firms excel at different things.
Exactly. Do your homework based on what you need.
Okay, let's end with a final thought, something for you to chew on.
All right.
Consider this increasing concentration of wealth, of financial power in the hands of just a few global giants. How might that subtly reshape things? Not just our personal finances, but maybe bigger things.
Like corporate decision-making, societal priorities.
Yeah. When a handful of entities hold that much sway through their investments, their choices on climate, on governance, on strategy become incredibly powerful. It's a massive shift.
A powerful shift, and definitely something worth watching closely in the years and decades ahead.